Welcome to the 14th lecture of Unit 2 in the Ethan Trades Mentorship. In this lecture, I will be introducing what balanced price ranges are, how they operate within a market maker model, and how we can apply this concept to the charts. In the last lecture, I introduced the concept of inefficiencies, denoting a period of time where there was an imbalance of either buy orders or sell orders within the market at any given time. As the name suggests, a balanced price range is the exact opposite. A balanced price range, aka a BPR, refers to a specific range of price where the market finds a temporary equilibrium between both buy orders and sell orders. In other words, an area where two inefficiencies overlap one another. Within price action, this is demonstrated by two opposing inefficiencies overlapping each other within the same range of price. So it could be a mix and match of any inefficiency that you previously learned in the last lecture, as long as they overlap each other. And so think of price action as a paint roller on a wall. Typically, you need to roll over a specific spot on a wall a couple times before the blotches are gone. And so this is the same concept with price. If you have an area of price with only buying, then you also need selling in that same area to balance it out. Vice versa, if you have an area of price with only selling, then you need buying in that same area to balance it out. And so that's where the significance of this PD rate comes in. A balanced price range is significant because the algorithm is showing its hand by immediately disrespecting a prior inefficiency and leaving a new opposing inefficiency. So in layman terms, not only is a prior bearish level, for example, so let's say in this right side diagram right here, not only is this bearish fair value gap being disrespected, but a new bullish fair value gap is being created while this is being disrespected. So here are some examples as I just pointed to. On the left is a bearish balanced price range, and on the right is a bullish balanced price range. And so the area of price that has two inefficiencies overlapping one another is the balanced price range PD array. And so in this example, I have included fair value gaps, but once again, any inefficiency works the same, so feel free to mix and match them as well. And so how you can start beginning to spot these balanced price ranges is you can first start looking for, just like the previous lecture, you're looking for inefficiencies, right? And so whenever you have one inefficiency being created, you can mark that out. So in this case, I've marked out the bullish fair value gap. Drew it out. And so once a new fair value gap is created here in this specific diagram, I also annotate a bearish fair value gap. And so the area where they both overlap with each other, that is the balanced price range. And so that's the area we refer to. If price trades back into it, we expect a bearish price action to continue. Vice versa, here we have a bearish fair value gap initially that I've annotated here. And then we see that it's disrespected while price creates a new bullish fair value gap. And so I've also annotated that bullish fair value gap here. The area where they're both overlapping each other, that is your balanced price range. And so if price returns back into it, we expect a bullish price action from there. The idea behind the balanced price range is that institutions or smart money is accumulating or distributing their positions when it's being created. So once again, going back to the significance of a balanced price range is because of multiple confluences coming together into one PD array. And so that goes back to your Unit 1 high probability analysis. And so when a balanced price range is being created, it's usually going to offer manipulation first in the opposing direction of the real move, and then drives price in the real direction, leaving behind a balanced price range. And so this area of price will be referred to by the algorithm because, as the name implies, it's a balanced price range. With this ideology now in your head, balanced price ranges will typically form when an AMD model is playing out. And so for this example, on the left here is a bullish balanced price range right here. And so if price was in a recent period of consolidation, then price would displace into that consolidation, because remember, fair value gaps or inefficiencies tell us that price is most likely displacing. will be displacing into those previous swing lows, or in this case, the consolidation low. If you watched Unit 2C and are just rewatching this, then that would be your liquidity raid. And then after leaving a bearish inefficiency here, we'll see a bullish inefficiency being left overlapping with that previous bearish inefficiency, telling us two things. One, we're displacing higher, and two, we're disrespecting previous bearish order flow, right? And so where both of these inefficiencies overlap, we look at that as a balanced price range. And so the algorithm will refer to that balanced price range as true support and resistance. And so in this case, if this was a scenario, we're expecting bullish price action from this balanced price range. Vice versa, on the right is a diagram of a bearish balanced price range. And if price was recently, once again, in a period of consolidation here, then we want to see price displace higher into that consolidation high, or if you've watched Unit 2C, your liquidity raid on buy side liquidity. And so it creates a bullish inefficiency here. And on the way back down, we want to see a bearish inefficiency that overlaps with the bullish inefficiency, telling us that not only is this bullish inefficiency being disrespected, but we're creating new bearish order flow, right? And so where they overlap, that's your balanced price range. Price trades back into it, and we expect expansion lower from that. And so here's a quick schematic of a market maker model that I made by copy pasting the previous slide. Just like in inefficiencies, just like order blocks, rejection blocks, I want to keep in mind the higher time frame narrative of price, right? And so here you have this market maker model. And typically, in my experience, the best place to look for a balanced price range is usually going to be the smart money reversal of a market maker model. Otherwise, majority of the time, balanced price ranges don't form too often. But whenever you zoom in on each individual accumulation or distribution phase, you'll see that these turning points in the market are market maker models of their own on a fractal scale. And so here's an example of a balanced price range, and I've pretty much annotated only at the smart money reversal, because other than that, I typically don't really pay attention to too many balanced price ranges. I think this is probably the highest probability time to use a balanced price range, because once again, for me, where candles form in proximity to one another is very important. And so I want to refer to a bullish fair value gap within the buy side of the curve, right? And then I want to refer to a bearish fair value gap on the sell side of the curve. And so if that's the case, then I want to see if price is going to disrespect that. It must be within close proximity. In this case, the smart money reversal will always be the closest proximity. Whereas if I were to use a bearish fair value gap from all the way back here, delineate out in time with this bearish fair value gap, then that would be much further in proximity, and that's why I think it's lower probability. On top of that, here technically you could use your premium and discount, which makes this one higher probability. But for now, let's just strictly focus on balanced price ranges. And in this case, the reason why I chose this one is because it's at the smart money reversal. If you were to go down to a lower time frame, then these turning points in the market of themselves, you'll probably find some lower time frame balanced price ranges that get respected, or market maker sell model right here, and then another market maker sell model right here on a fractal level. That's all for this lecture, and as always, the homework and quiz for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity, study, and do the work honestly. I promise your hard work will be rewarded. Your assignment for this lecture is to go into your own charts and annotate balanced price ranges, as well as note-taking when they work, when they don't work. And as I mentioned previously, I personally only look for balanced price ranges when there's a smart money reversal occurring, or I'm immediately reading order flow in the moment. Let's say I'm in a bearish trade, for example, and a bullish fair value gap forms out of nowhere. Then I'll be watching that bullish fair value gap that created out of nowhere and see if it gets inverted, meaning we close below it, while creating a new bearish fair value gap. And so that's when I would use a bearish balanced price range to manage my trade, for example. Balanced price ranges are definitely one thing that I would say is more niche and that's because it's higher probability. Moving forward, you will have a greater grasp on when to use it, how to use it. But for now, I just need you guys to be able to spot it just with all the other PD arrays. At the end of this unit, I will be introducing how to tape read and put everything together. But I'm sure the more you backtest, the more you study, you've already started to figure out how to apply everything together. See you in the next one, and as always, have a great day.